Data from Nationwide has shown that houses fell last month by 0.9%. Now, this is the biggest fall since June 2020. Does this, on top of everything else that's going on, indicate the beginning of a housing crash? Investing in houses has always been perceived as one of the safest ways of getting rich. People have been doing it for decades and they've done pretty well out of it. But interest rates doing what they're doing, inflation doing what it's doing, means there is an increased pressure on those looking to remortgage and first-time buyers. We've been spoiled. We've been used to rates below 2%. We've had that for a very long time, and I don't think we're going to see those rates again anytime soon. This on top of the energy price increases that we've seen, on top of Mr. Hunt giving us a 5% increase on our council taxes from next year. Does this mean we're heading towards a massive crash? Interest rates are now at 3%. This is the highest that they've been since 2008, so for 14 years. And actually, if you're looking to get a mortgage at the moment, they're looking at being anywhere between 5.75% and 6.5%. Now, that's nowhere near the numbers that we're used to. Don't forget, the Bank of England interest rate going up means it's directly correlated with interest rates going up. So the Bank of England interest rate going to 3% means that those that sell mortgages are going to want to add their little bit in the middle to make sure that they're making their mortgage margin, making profit. They're a business at the end of the day, so they're going to put a little bit on top as well. So any interest rate increase in the Bank of England is going to be seen within interest rates within mortgages. This means if you've got a mortgage at the moment for around £200,000, you could see your payments go up by 50%. Not only does that mean your payments are going to be going up, that means then that your buying power gets reduced. If you're a first-time buyer and you're looking to get on the housing market, this time last year, you could afford 200k. Now perhaps you can only afford 100k. So that means that the demand for those houses is going to reduce. And at this point, it's really important to note that in any given year, 50% of the market is made up by first-time buyers. So in order to stabilize a housing market, you need to make sure that first-time buyers are buying houses. You need to make sure that they're happy that they can get on the ladder. Otherwise, again, the demand goes down. What happens with supply and demand model? As the demand goes down, the prices go down. Now, if you are remortgaging within the next year or so, 18 months, and you've been used to a 2% rate, you're probably going to see the rate of interest that you pay go up by about 50%. Again, if you were looking to make another step up on the housing market, move to a bigger house, a nicer house, whatever it was you had planned, perhaps you may reconsider that now. It could even mean that you can't even afford it. You go to remortgage and you're looking at the numbers and thinking, well, I can't afford to make these payments. Therefore, one of your only options is to extend the mortgage. You could have had 15 years left. You now need to extend it to 25 years. Just to get to a point where you can afford to pay the monthly repayments. This in itself, right now, could have a generational impact. Personally, I'm looking at leaving my house to my kids. I'm looking at trying to pay it off in the next 15 years. That's my plan. If I'm not able to do that and it goes on even longer, it could mean that there's less to leave. Inflation, that's just gone up as well. We're now at 11%. We've seen numbers as well come out recently that the average pay increase has been around 6%. So that's a 5% deficit. So the average man, woman, child is 5% worse off versus where they were this time last year. Now, if you're in the public sector, you're probably even worse off. This means that all of these people have got less disposable income. They've got less cash to be paying for mortgages, less cash to be buying houses. Without disposable income, you're not going to be buying houses. Again, the demand goes down. Now, if you can stay put and you're on a fixed mortgage and you've got a relatively long period of time, 5, 6, 7 years, perhaps you're probably going to be laughing. But the rest of us, and most of the population at the moment, are not going to be in that position. So this is going to have an impact on the majority of the population. And it is the first-time buyers that are going to be affected most by all of this. And because they make up so much of the market, 50% of the market, like we said, it can't not have an impact on the housing market. It can't not. Next, I want to touch on a buy-to-let. Now, if you were thinking about getting into a buy-to-let property, all of a sudden, looking at those numbers, they don't make anywhere near as much sense anymore. I was thinking about potentially looking to get some property within the next couple of years, 2, 3, 4, 5 years, I don't know. I was looking at definitely doing it as the next step within my investment portfolio. But now when I look at the numbers, it makes absolutely no sense. I've completely scrubbed the idea for at least 2 years. It used to be that that was the way to wealth. And if you could put up with people ringing you in the middle of the night because they've got hedgehogs in their sinks or whatever it is, that was a really good way of making a decent amount of cash. As it is now, rents will probably not cover mortgages. So either people are going to need to increase the rents and you could put yourself in a position where people can't afford to pay the rent, so they're going to leave, or you're going to be defaulting on your payments, or you're going to have to pay for it yourself out your own pocket. Now, unless you've got a massive deposit, which some people do. Some people go in with big deposits and they're in a position where they're able to do that. The numbers are just probably not stacking up for buy-to-let at the moment. Now, if you're already in a position where you've got a house and you've had it for a number of years, different scenario. We won't go into that. Maybe you're going to be okay and you'll survive this without a problem. So what happens next? That's the key thing. So the market is assuming that we're going to see an increase up to around 5%. So that's going to be a pretty desperate situation. If we get to a position where base rate is at 5%, you're going to be looking at mortgages starting at 8% and going up from there. That is going to be in a position that is really going to be problematic for the UK. Now, it could go down. This is the thing with all of this stuff. No one knows. It could go down. We could go anywhere from 5% back down, not towards 0%. We're not going to see that again, I don't think, but it could go down from here. And in that instance, perhaps all of this will blow over and it'll be no issue. I think it's less likely to go down, and I think it's more likely to go up. So what does this actually mean then? Well, don't forget, I'm not a financial advisor. I'm not a mortgage broker. I'm just telling it as I see it, but I think that this could mean that we see a correction rather than a crash. We will see a bit of a pullback in house prices over the next 12 months, but a big 30% drop, not so sure about that. Now, if you're interested in any of this sort of content, please do consider subscribing. Give this video a like if you took any use out of it, and check out these other videos that I've got here as well for you.